right. Perfect. It is 4:00 Eastern, so we'll get started right off the bat. Right away, appreciate everybody for making the time this afternoon to join us for our monthly webinar. This will be the August version of our Making Sense of the Market with Chris Kerlow and Team LWC. Before I pass things over to Chris, my name is Mitchell Shields. I'm the financial planner with Team LWC. I'm going to be moderating the call today, and essentially I'm going to be, checking on the questions that come in. You'll notice at the bottom there's a section to ask some questions. So if you have any questions through the call, just put them there, and we'll make sure to address them at the end of the conversation here. But without further ado, I'm going to pass things over to Chris, who's going to take us through the presentation today titled Downgrade. Doldrum. Awesome. Take it away, Chris.
Thanks, Mitchell. And thank you, everybody, for joining. So Downgrade Doldrum. So what is that entailing? Yesterday, the U.S. credit rating was downgraded by a rating agency, Fitch, to AA. Their rationale behind that was the fact that their U.S.'s debt to GDP has gone from about 3% all the way up to 6% over the last 2 decades, and then an erosion of the governance compared to other countries in the world that are rated AA and AAA. They've been doing these on again, off again debt limit standoffs, which the rating agencies didn't really like. That doesn't come as a huge surprise to us. They were put on watch back in May as the debt debate escalated further. The market did pull back fairly significantly yesterday, down again here today. But don't worry, we're still only back to where we were in about mid-July. So just giving up about 2 weeks of gains. Fortuitously, we've been kind of paring back our equity exposure over the last couple of weeks. On Monday, we trimmed a position in Uber, and with those proceeds, parked it into cash equivalent U.S. money markets, which is yielding us over 5% right now. So pretty, not a bad place to be on the sidelines while some of this turmoil plays out. We weren't really expecting the pullback to be caused by a debt limit or a debt downgrade. Things were starting to get a little frothy in the market. The volatility index, which is essentially a fear gauge, had gone to historically low levels, running below 14, as well as sentiment readings in the United States and abroad have gotten extremely bullish. We talked about that before. That's super optimistic, and the people super pessimistic had gone to one of the lowest levels in a couple of years. All that said, we're starting to see inflation expectations rise again in the market, as the market's pricing in a pausing from the U.S. Federal Reserve and Bank of Canada. All of that's not good for high duration assets like long dated bonds and technology stocks. We saw a bit of a pullback there. That does come off the back of an extremely strong start for the NASDAQ, which is up over 30% year to date. And when this happened previously, so in August 2011, or I think it was in June 2011, we saw Standard & Poor's reduce the U.S. credit rating. The market took a concurrent dip at that same time, and then by the end of the year had come back. So we think that there's more to it than just a rating agency's opinion of the U.S. credit system. There's several other factors that roll into this. We are seeing improving economic data, which would give us indication of a softer landing. Before I jump into that, I'll highlight this chart on the top right. This is showing you that sentiment of bearish readings in the black line, kind of trending lower back to that 2020 level over here on the right. And then this other one is that VIX, again, at the lower end of that fear index, as it's often referred to as. What I was talking about on the economic side is the economic surprises coming out of the United States have been a lot better than what was expected. So that's a positive sign. Hasn't been as good in Asia. We've seen that slow recovery out of China, and then the Eurozone not quite doing quite as well economically as well, with the Bank of England hiking for the 14th time here again today. But fortunately, inflation has dropped significantly. We're down to 5.4% in June, which was 9.3% a year ago. So that's a positive note for all of us having to buy food, groceries, gasoline, etc. That's come significantly down. And CPI is now within the Bank of Canada's target range below 3%, with the biggest part of inflation coming from non-residential structures. That's actually a good thing, because that shows that the industrial complex and the manufacturers are willing to invest and bidding up prices on those structures. The market has kept expecting that the Fed will cut rates, but that continues to get pushed back into the future. And analysts are now expecting that the earnings kind of troughing that we've seen over the last few quarters should be bottoming out this quarter, which could set up for earnings expansion going forward and be supportive for stock prices. All of that put together, although the economic situation might not be fantastic and inflation is high but falling, still sets up for a decent backdrop for equity markets to, recover. Surprise if this current bout of turmoil extends a little bit further, draws things down slightly, at which point we would be deploying some of the dry powder that we've accumulated in the form of cash. Moving on to the consumer and inflation, the Fed is painting a bit of a less rosy picture. They expect unemployment to peak under 5%, but normal unemployment does tend to trend a little bit higher than that. You could look back at the .com era when that bubble burst. You saw peak unemployment at 6.3%. Following the 2008 crisis, we hit 10. In the pandemic, we had a slight uptick to almost 15%, where we've been very sticky here. Sub 5% unemployment on the US, at 3.6%, similar type of level here in Canada. So the consumers remain very healthy throughout this entire period of uncertainty, which has helped boost the consumer confidence index back to a 2-year high. However, inflation is a self-fulfilling prophecy, and the longer term, this light blue line, for those of you that can see it, is trending higher. So people do expect higher inflation in the future, and that can breed into higher inflation as those prices work through the system. It's moved up actually almost a whole percentage point from August of last year to June of this year. On top of that, the FOMC still expects to have to hike rates twice more this year, which should help rein in inflation, but those expectations are fading or coming closer to the end than the start of this rate hike cycle regime. One of the bigger impacts on the consumer has been rising mortgage costs, particularly here in Canada. I'm going to skip over to that first and come back to the banking sector. That has placed a bit of a headwind for the Canadian housing market, but the last several months have been moving into a positive direction. You're seeing that in the chart on the top right, with housing sales in Canada on a seasonally adjusted basis starting to move higher, particularly versus a year ago. We saw strong numbers again out of the TREB, Toronto Housing Rating Agency today, where all housing listings, housing sales, and home prices all moved higher. Looks like a bit of a pause in the Bank of Canada has helped on that. But CPI, not including food, energy, and mortgage interest, is now back within that zone at 2.5%. And the biggest part of being closer to 3 has been that uptick in interest income. Question is, has the Bank of Canada gone too far? Typically, policymakers tend to swing a little bit too far in one direction and then the other. We saw that with what Powell was calling transient inflation last year, and has now risen interest rates over 5%. And another positive sign is that the real estate market is seeing less listings canceled. We've seen a big month-over-month decline on those cancellations. Another interesting piece of news that came out this past week was increased requirements on the banking sector. So big banks in the United States will now be required to hold more cash on their balance sheets following the Silicon Valley banking crisis. They've also imposed a fee on uninsured deposits That was really what got SVB into trouble. Those uninsured deposits fee kind of penalty caused about 55 banks to reduce the amount of uninsured deposits they reported previously. So that's kind of an interesting game theory aspect that's happening there that could place a bit of stress on the US banking sector later on in the year. And then on our side of the border, OFC, our regulators battling negative amortization in mortgages. What this means is your monthly payments are less than the interest you're paying. So the actual mortgage obligation is growing. This is a practice done by TD, RBC, and CIBC. Scotiabank does not have this type of product in their arsenal. So you can see that there's almost basically nothing there, where you have about 25% percent of the residential mortgages in the other three banks I mentioned, in that position where they're negative amortization, where the monthly payment is less than the interest. That can be a problem and is being reviewed by the regulators. And they're going to be looking for higher loan to value in any of those situations going forward.